Hi there, it's Friday the 15th of March, the Ides of March 2019. I'm Steve Towers. Welcome to ITB. Let's get started. Let me take you through the key themes which emerged in this week's public consultation meeting. I'll start with Pillar 1, which occupied the whole of the first day. Starting with the big picture, there seemed to be a consensus on the key attributes of the solution. It needs to be principle-based. It needs to be simple, certain, and globally adopted. And it also needs to be accompanied by strong dispute avoidance and dispute resolution mechanisms. A number of folks referred to mandatory binding arbitration. Some speakers emphasised that the Pillar 1 proposals will involve winners and losers at the country level. After all of the proposals involve an increase in market countries' taxing rights. An executive from Lafarge said that they have modelled the potential impact of the marketing intangibles proposal, and they concluded that 75% of their taxable profits would be transferred from developed countries to developing countries. Of the three proposals in Pillar 1, the marketing intangibles proposal is clearly preferred. Two or three speakers advocated the significant economic presence proposal. Strangely, no one spoke in support of the user participation proposal. There was a large amount of discussion on the profit allocation aspects of the marketing intangibles proposal. Most significantly, there was considerable support for a formula-based approach, either as the definitive method or as a safe harbour which could be elected by the multinational. And there was a lot of interest in a model which was described by Catherine Amos of Johnson & Johnson. Under that model, there would be a base rate of return for marketing intangibles. That base rate would then be increased or decreased by two so-called levers. One in regard to the level of group profitability and the other in regard to the level of marketing expenses. But that adjustment would then be subject to so-called guardrails, a floor and a ceiling. Some folks noted some consequential issues with the profit allocation topic. Firstly, what would be the impact on other taxes, such as VAT and customs duty? Secondly, what would be the impact on existing APAs? And finally, what would be the impact on capital gains on the sale of marketing intangibles? The nexus issue with the marketing intangibles proposal was also discussed. Paul Oosterhuis of Skadden made a couple of interesting points. Firstly, he said that all forms of distribution into a market country should be covered. He gave the example of an Italian dressmaker whose product is sold in the US through 4 channels: the dressmaker's own website, Amazon, the dressmaker's own boutique store in New York, and Saks Fifth Avenue. Secondly, in regard to both third-party B2B sales and third-party licensing, he asked whether the relevant market jurisdiction will be the jurisdiction of the third-party purchaser or licensee, or will it be the jurisdiction of final use? A number of speakers identified some significant implementation issues. For example, a specific legal entity within a multinational group will need to be identified as the relevant taxpayer for the market jurisdiction. If that legal entity is not resident in the market jurisdiction, its selection could be controversial. For example, its residence jurisdiction might have a different view. Also, that specific legal entity will be the entity which will have a legal liability for the tax in the market jurisdiction. This raises the issue of the market jurisdiction's ability to enforce the liability. And of course, double tax treaties will need to be changed, particularly Articles 5, 7 and 9, which raises the question, what do you do with the US, which has been unable to ratify any treaties for many years? There was less consensus in the discussion of the Pillar 2 proposal, the Global Anti-Base Erosion proposal, on the morning of the second day of the meeting. Unlike Pillar 1, which involves an expansion of the taxing rights of market jurisdictions, Pillar 2 was described as an anti-avoidance measure in regard to the BEPS project. It was supported by various speakers from civil society, but it was questioned by business representatives. Those business representatives made a number of points. Firstly, the relationship between Pillar 1 and Pillar 2 needs to be better explained. For example, the Global Anti-Base Erosion proposal can lead to an increase in the market jurisdiction's taxing rights. Isn't this an overlap with Pillar 1? Secondly, if it's meant as an anti-avoidance measure in regard to the BEPS project, it's premature. Folks should wait to see the results of the BEPS project before deciding whether it's necessary. And thirdly, it encroaches on jurisdiction sovereignty, the sovereign decision in regard to setting tax rates. If you want to watch a video replay of the consultation meeting, you can do so. For the relevant link, please go to our website or app. As expected, Ecofin failed to agree on the EU's proposed digital advertising tax at this week's meeting. Nevertheless, the European Commission has indicated that it will not withdraw the proposal for two reasons. It will provide guidance for member states which want to introduce such a tax, and it will still be on the table if the OECD's efforts for a global solution end up failing. Meanwhile, France's proposed digital services tax is starting to receive threats from the US government. Possible US responses include a WTO challenge and increased tariffs on US imports from France. And the IMF has issued a policy paper on corporate taxation in the global economy. For a copy of the paper, please go to our website or app. In Australia, the tax authorities have issued the final version of guidance on the transfer pricing issues related to inbound distribution arrangements. This guidance was originally issued in draft form late last year. For a copy of the final guidance, please go to our website or app. In India, the tax authorities have issued guidance on the GST treatment of certain sales promotion schemes, in particular free samples and gifts, buy one, get one free offers, discounts including buy more, save more offers, and so-called secondary discounts. discounts which are not known at the time of supply. For a copy of this guidance, please go to our website or app. In Japan, the tax authorities have published a redacted private ruling in regard to a pre-Brexit corporate reorganisation in Europe. A Japanese multinational plans to transfer the business of its UK subsidiary to a newly formed Netherlands subsidiary prior to the 29th of March, in anticipation that the UK will leave the EU on that date. The ruling indicates that the proposed transaction would be considered to be a tax-qualified merger under Japanese rules, which means that no gain would be recognised on implementing the transaction. For a copy of the ruling, please go to our website or app. In New Zealand, the High Court, which is the court of first instance, has decided a case called Cullen Group in regard to the application of GAR to an interest withholding tax avoidance scheme. But first, some background. New Zealand adopts two ways to impose tax in regard to interest paid to non-residents. The first way is interest withholding tax, which is levied on the non-resident interest recipient at a 15% rate on gross interest. The New Zealand payer of the interest has a collection obligation for this tax. And the second way is the so-called approved issuer levy. This is a tax which is imposed on the New Zealand payer at the rate of 2% on the gross interest. If the approved issuer levy applies, then the interest withholding tax does not. There are certain requirements to qualify for the approved issuer levy. Relevant to this case is the requirement that the lender is not an associated person in relation to the New Zealand interest payer. The essence of the tax planning in this case was to ensure that the relevant interest payments qualified for the 2% approved issuer levy instead of the 15% interest withholding tax. Let me take you through a simplified version of the facts. A Mr. Watson owned all of the shares in a New Zealand company called Cullen Investments Limited. He sold all of those shares to a newly formed New Zealand company called Cullen Group Limited in consideration for debt issued by that company to him. Mr. Watson then assigned that receivable to two Cayman Island companies in return for debts owed by those two companies to Mr. Watson. So, after these transactions, Cullen Group Limited owed debt to the two Cayman Island companies, which in turn owed debts to Mr. Watson. Therefore, interest was paid by Cullen Group Limited to the two Cayman Island companies, which in turn paid interest to Mr. Watson. The shares in Cullen Group Limited and the two Cayman Island companies were owned by trust estates which were substantially controlled by Mr. Watson. At about the same time that these steps were implemented, Mr. Watson changed his tax residence from New Zealand to the UK. Now, even though the two trust estates were substantially controlled by Mr. Watson, it was accepted by the New Zealand tax authorities that after these transactions were implemented, neither Mr. Watson nor the two Cayman Island companies were connected persons in regard to Cullen Group Limited. This meant that the interest paid by Cullen Group Limited to the two Cayman Island companies satisfied the conditions for the 2% approved issuer levy and exemption from the 15% interest withholding tax. However, the tax authorities challenged this planning under New Zealand's GAR rule. That rule has a number of requirements, but the key requirement which was relevant in this case was expressed by the court in this way. Viewed in light of the arrangement as a whole, the taxpayer has used specific provisions in the tax legislation in a way which cannot have been within the contemplation and purpose of Parliament when it enacted the provisions. The court held that the planning which enabled Mr. Watson to substantially control the two trusts, but which also allowed both himself and the two Cayman Island companies not to be connected persons in regard to Cullen Group Limited, satisfied that requirement of GAR. The court concluded in this way. Parliament enacted the AIL regime with the objective of encouraging investment in New Zealand by reducing the cost of New Zealand residents borrowing from non-residents. The arrangement here introduced no new funds into New Zealand. It restructured shares in one New Zealand company, Cullen Investments Limited, into loans to another New Zealand company, Cullen Group, which were assigned to overseas entities, the two Cayman Islands companies, in form but not substance. Mr. Watson retained a high degree of control over the relevant entities and was on both sides of the loans. I do not consider the arrangement was within the contemplation and purpose of Parliament in enacting the AIL regime. One of the interesting aspects of this case is that neither the tax authorities nor the court applied the GAR rule to reconstruct the facts. For example, by ignoring the existence of the two Cayman Island companies and treating Cullen Group Limited as paying interest directly to Mr. Watson. Instead, the facts were accepted as is, but the connected person condition for the approved issuer levy was held to be breached. That meant that the levy did not apply and that Cullen Group Limited was liable for 15% interest withholding tax, presumably on the basis that it failed to collect the tax. For a copy of this case, please go to our website or app. In its March infringements package, the European Commission has indicated that it has sent letters of formal notice in regard to direct taxation to Finland and Spain. A letter of formal notice is the first and most polite level of the 3 levels of Commission aggravation with member states. In regard to Finland, its letter says that current Finnish legislation does not allow a tax deduction for group contributions made to affiliated companies in other EU or EEA member states, to the extent that the contributions cover definitive losses. According to the Commission, that's a breach of the freedom of establishment. And in regard to Spain, its letter refers to Spanish capital gains tax on the transfer of shares by residents of EFTA states, Norway, Iceland and Liechtenstein. Spanish and EU residents benefit from a tax exemption if certain conditions are satisfied, whereas there's no such exemption for taxpayers resident in Norway, Iceland or Liechtenstein. According to the Commission, that difference in treatment breaches the freedom of establishment and the free movement of capital. The EU has updated its blacklist of non-cooperative tax jurisdictions. There are now 15 jurisdictions on the list. Firstly, there are 5 jurisdictions which have made no commitments since the first blacklist was adopted in 2017. American Samoa, Guam, Samoa, Trinidad and Tobago, and the US Virgin Islands. And secondly, there are 10 jurisdictions which have been moved from the grey list: Barbados, UAE, Marshall Islands, Aruba, Belize, Bermuda, Fiji, Oman, Vanuatu, and Dominican Republic. For a copy of the European Commission's press release on this matter, please go to our website or app. And in regard to VAT, Ecofin has agreed on 2 legislative proposals which will provide detailed measures needed to simplify the VAT collection rules for sales of goods online. In the words of the European Commission, the new measures ensure that online marketplaces play their part in the fight against tax fraud. The new rules will apply from the 1st of January 2021. For a copy of the 2 legislative proposals and the Commission's press release on this topic, please go to our website or app. Various EU member states are putting in place transitional tax rules in case a no-deal Brexit really does happen on the 29th of March. In this last week, we've seen both France and the Netherlands take some action. France has published a decree in regard to its dividend participation exemption. A UK subsidiary, which is at least 95% owned by a French parent company, will continue to be treated as located in the European Economic Area for the remainder of the 2019 tax year. This would mean that the French parent would enjoy a 99% exemption on dividends received from the UK subsidiary during that time. In the Netherlands, the government has released a draft decree which would deem the UK to be an EU member state for the current tax year or the current financial year, which commences before the 30th of March 2019. This deeming would apply for a range of Dutch tax laws. The draft decree will be finalised on the 28th of March if it then looks clear that a no-deal Brexit will occur. In Germany, the Federal Tax Court has decided a case concerning the German trade tax treatment of a cash pooling arrangement. For trade tax purposes, a deduction is disallowed for 25% of interest expense in excess of €100,000. There's no corresponding exemption for interest income. Thus, in a situation like cash pooling, where a participant might have a payable, a negative cash balance, owed to the header entity on one day, but a receivable, a positive cash balance against the header entity on another day, it's important to work out exactly how the interest is calculated. In this particular case, the interest was calculated at a rate of 5.5% per annum on the positive or negative cash balance, and then booked on a net basis each month as either income or expense. It was that net calculation on a monthly basis which was in dispute in the case. The court held that on the facts in this case, that monthly net calculation would be respected for trade tax purposes. Important elements in the facts included that the same interest rate applied to both positive and negative cash balances, and the same contractual terms applied to both. For a copy of this case, please go to our website or app. Also in Germany, the idea of the tax authorities to impose withholding tax on outbound payments for online advertising has been scrapped. That's the message in a press release which was issued yesterday by the Bavarian Ministry of Finance. For a copy of the press release, please go to our website or app. In Italy, the tax authorities have issued guidance on the impact of a corporate reorganisation on the holding period for the capital gains participation exemption. On the particular facts considered in the guidance where there was a purely internal reorganisation, the tax authorities indicate that the holding period is not interrupted. In other words, the new owner inherits the holding period of the previous owner. For a copy of this guidance, please go to our website or app. In the Netherlands, the government has issued a decree which makes some changes to the rules concerning the participation exemption, in particular in regard to option rights. For a copy of the decree, please go to our website or app. In the UK, the Supreme Court has decided a case in regard to the withholding tax treatment of £5 billion of statutory interest which is payable to the creditors of the insolvent Lehman Brothers International Europe. The issue was whether the statutory interest was or was not yearly interest under the UK's historical distinction between yearly interest and short interest. The court held that the statutory interest is yearly interest, and thus withholding tax applies. For a copy of this case and a summary prepared by the court, please go to our website or app. And also in the UK, the First Tier Tribunal has decided a VAT case concerning missing trader or carousel fraud. The taxpayer claimed an input tax credit for VAT it had paid on invoices in circumstances in which, according to the tribunal, the taxpayer had reasonable grounds to suspect that the suppliers were engaged in VAT fraud. The tribunal held that an input tax credit would not be given for most of the VAT paid by the taxpayer. For a copy of this case, it's 311 pages. Please go to our website or app. And amongst the Brexit debates this week, the UK government also delivered the Spring Statement. Several public consultations were announced, the most interesting being a consultation on infrastructure finance and a consultation on the key features of the Structures and Buildings Allowance, which was announced in the 2018 budget. The government also released several interesting publications, two of which caught my eye. A policy paper on tackling tax avoidance, evasion, and other forms of non-compliance, and the No Safe Havens 2019 strategy, which refers to tax avoidance and evasion in offshore locations. For a copy of the publications and for information on the public consultations, please visit the ITB website or app. In Nigeria, the tax authorities have issued guidance on the mutual agreement procedure. For a copy of the guidance, please go to our website or app. In Bahrain, the tax authorities have issued guidance on the VAT treatment of real estate transactions. For a copy of the guidance, please go to our website or app. In Colombia, the tax authorities have issued guidance in regard to the transitional rules concerning dividend withholding tax. In particular, the guidance clarifies that for dividends which are paid out of profits derived before the 2017 tax year, no dividend withholding tax applies. regardless of when the dividends are paid. The US Court of Appeals for the Federal Circuit has decided a case, Canadian Solar, in regard to countervailing and anti-dumping duties imposed on the import into the US of solar cells and panels from China. The issue in the case was whether the US Commerce Department had correctly determined the country of origin of the imported goods by applying a country of assembly test. The lower court, the Court of International Trade, had held that the Commerce Department had used the correct test. The Court of Appeals affirmed the lower court's decision. For a copy of this Canadian Solar case, please go to our website or app. And there were some interesting comments made by US government officials at last week's Federal Bar Association annual conference in Washington. Firstly, in regard to GILTI, a Treasury official stated that the government is considering some additional relief in regard to the allocation of expenses to be included in the final regulations. Secondly, in regard to the proposed anti-hybrid regs, a government official defended the inclusion of notional interest deductions within the scope of hybrid transactions, even though BEPS Action 2 expressly excludes them. And thirdly, a government official said that the forthcoming Altera decision from the US Court of Appeals for the Ninth Circuit is expected to have a very big impact, not just on stock-based compensation, but I think more broadly on the interpretation of the arm's length standard. And now for this week's treaty developments. We've had one treaty signed and two treaties enter into force. I have two articles for you this week. The first article is called The WTO Consistency of the Deduction for FDII. It's written by Grant D. Aldonis and it's published in the Tax Notes International Journal. In this article, the author considers the allegations made by several European finance ministers that the US Foreign Derived Intangible Income FDII regime breaches the WTO rules against export subsidies. He concludes that it does not. As a quick reminder, at the heart of the FDII regime is the Section 250 deduction, which has the effect of generally reducing the effective US tax rate on the relevant income to 13.125% up to and including the 2025 tax year, and to 16.406% thereafter. The author writes this: both rates are substantially below the statutory rate of 21% otherwise applicable to the taxpayer's non-FDII eligible income. Thus, it would not be all that difficult for a complaining WTO member to make a prima facie case that the FDII deduction falls within the scope of the SCM agreement's definition of subsidy, as would any deduction, credit, or exclusion in the code. Although there are substantive arguments that might be raised in opposition, let's assume that a complaining party could establish a prima facie case. The question is whether that alone is enough to find Section 250 in violation of the WTO rules. as the following discussion clarifies, it is not. The key point which the author makes is that the Section 250 deduction is not contingent on the export of goods from the US, and therefore it does not breach the SCM agreement. The author writes this: nothing in Section 250 obliges a US taxpayer to export goods as a condition of qualifying for the deduction it provides. Although Section 250 may include income from export sales as part of the calculation of the ratios that determine a taxpayer's FDII, that is quite different from conditioning eligibility for the deduction on the export of goods. Indeed, a US taxpayer can clearly qualify for the deduction without income from the export of goods. Notice the emphasis on the export of goods. This is explained by the author a little later in the article. Section 250's use of the phrase property which is sold to a person who is not a United States person for a foreign use is broad enough to include the export of goods. But that does not imply that the export of goods is necessary to establish that the taxpayer has FDII eligible income, or that its ability to establish that it has such income is contingent on the export of goods. The phrase embraces a wide variety of other sources of income, including the sale to a foreign person of services, patents, trademarks, customer lists, and even sales of foreign real estate, plants, and equipment the taxpayer may hold abroad. The statute does not distinguish among these sources of income, much less reflect a preference for the export of goods over other sources of foreign income that would satisfy the definition of FDII eligible income. One thing it clearly does not do is require the export of goods to qualify. The second article is called Cognitive Biases in Functional Analysis Interviews, Part 1, Introduction and Biases Affecting Selection of the Persons to be Interviewed. It's written by Aditya Pounse and it's published in IBFD's International Transfer Pricing Journal. Let me quote from the introductory paragraph. Functional analysis is a vital component of the transfer pricing analysis, and functional analysis interviews are a popular way to perform it. However, functional analysis interviews often suffer from unintentional or inadvertent blind spots on the side of the participants to the interviews, known as cognitive biases. This is the first of a series of articles that describe some of the most commonly observed cognitive biases, their effects, and possible ways to avoid the impact of these biases. And I'll give you one example from the article. Given the availability of powerful search engines, it is incredibly easy to find information that corroborates with people's existing beliefs. This is called confirmation bias, which is the tendency to search for, interpret, favour and recall information in a way that confirms one's pre-existing beliefs or hypotheses. For example, consider a person who watches a TED Talk video on artificial intelligence one night and starts seeing its applications everywhere, Baader-Meinhof phenomenon, believes that this must be something new, recency illusion, and consults a search engine to search for how artificial intelligence can revolutionize, say, the supermarket business. the results this person obtains are more likely to confirm the notion that technology is indeed the most crucial factor in business, confirmation bias. This may then lead that person to select more people from the technology team for functional analysis interviews, resulting in selection bias, which assigns more importance to a function that, in practice, may be of less importance. Well, that's the way it is this Friday, the 15th of March, 2019. I'm Steve Towers. Have a great weekend.